Happy holidays, everybody. And this is Sunday morning. It's still morning. It's not quite noon. And it is 12/27, 2015. This is Jeffrey Scott, a.k.a. HGSI Doc, back with my weekend review. I have been absent the last couple of weeks because I've been in the process of moving. I've also started a new company with some of my partners, and it's been keeping me busy. Going forward, I'll try to continue doing these on a weekly basis to the best that I can. But since I do this for free, there's always the likelihood that from time to time I will be distracted from my life and not get to them, especially now that I'm back working. So I've titled today as Tax Law Selling Eases. The question, will Santa bring us a joy or a lump of coal? Although last week coal wasn't a bad place to be. Let's take a look at the market. Disclaimer, this is for education purposes only. Anything recommends in the spirit of education, not investment advice. I'm a doctor, not a broker. I am truly independent. No one pays me to say good or bad things about them or anyone else. I have paid for all the tools that I use. And as always, I assume that you're well aware is that trading involves risk, and you alone are responsible for any investment decisions that you make. Now, education is critical, and you don't get to be a good trader without learning. And I learned from a number of folks, and then I sort of identified where the things that really made sense to me were and gravitated to those and really built my foundation really on two different perspectives. One is the world of Cancelim on the left, O'Neill's book, great book. I still read it on an annual basis. And then his disciples, O'Neill, Morales, and Katcher, really, I think, took Cancelim to a new degree with some of their thoughts in new indicators like pocket pivots and Bible gap-ups, probably foretelling of the future. Their short-selling book came out this year. Ian Woodward, God bless him, what a great guy, mid-80s now, still doing seminars, still brilliant strategist and trader, and Ron Brown, his partner in crime. And then George Lee here, who is sort of more of a friend and colleague and a co-speaker. We do a lot of programs together. I've married that world with how do you actually take trades and when to take them with what I've learned from John Person. John has been trading since the 80s, commodities and futures and options world. Today, he's a great teacher, trainer, trader. John covers the entire run of potential trading from stocks to options to futures. I spend a lot of time in his room. When he talks about currencies, he's usually using futures and not trading pairs. He's an outstanding trader. He has a number of trading rules and indicators, which hasn't changed for over a decade. And to me, a mark of something that's good is when it keeps working despite what the overall market is doing, and you don't have to change it every year and come out with new indicators. He's authored a number of great books. He's got great live seminars, and I run a user group independent of John, which he's been popping in and helping me run as well for folks that, on my urging, have actually bought his indicator set. And then just like I put George here is a big part of my trading life, Van Tharp, from a position sizing and money management, I find to be very useful as well. I have a lot of things on my desktop. I usually try and hide it on purpose so that it doesn't overwhelm you. But I need a real-time platform, whether it's TradeStation or Thinkorswim. I like Genesis for great clean charting and scanning, but I recognize that at $2,000 and additional fees per year for data that most people are not going to be following me there, so I don't talk much about it here. I use HGSI for my end-of-day and intraday analysis, EdgeRater to supplement that. I'm a big fan of seasonality. I try not to take sides. Just a couple comments. Best Choice apparently has been sold. There have been some comments in the user group that I bought it. I don't have any interest in owning a software. I made some decisions. I was thought about potentially trying to buy one of the other programs on this page. I'm just not sure it makes sense for me. I mean, I'm not a programmer. I'm a trader. I'd rather use programs and buy them rather than buy companies. Magenta, still a great program, but I really think the winner right now and the full featuredness is Seasonality Trader, although each of them have their merits, and then I use a number of websites. Sometimes I just take a quick picture of the market. Now, we have to remember last week was not a real week. Yes, the P&L was real. Yes, it was Monday through Thursday were real trading days. But, by middle of the day, Wednesday, who was left? A bunch of us amateurs. The volumes were low, and sometimes you have to wonder how much to put in and to actually give merit to the happenings on a holiday shortened week like this time of year. That said, there clearly was some changes where we saw some of the coal stocks and things start to move up. You could see here strength at the end of the day on transports, including trains, those and planes, gold miners, home builders, REITs, casinos showing strength, regional banks showing strength, as there was some clear buying off the bottom. Even some of the E&P stocks earlier in the week started to move. If you don't believe me about buying off the bottom, take a look at 3D printing, talking about things have been thrown out, babies with the bathwater, although I think in each case the baby was dead. Major markets tell a story on a daily chart. You can really see that here on the E-minis, a big move up from the August and the September lows, sort of struggling here at a confluence of major moving averages. And all my charts, green is the 17, yellow or blue is the 50, depending on a white chart or black background, and red is the 200. So the E-minis struggling right under the 50. The NQs right at the 50 with resistance. The YMs right again in the same level, failed at the 50 on Wednesday. Thursday could not break above it. The small stocks, the Russell, clearly the weak sister here, stuck between the 17 and the 50, and unlike the others, way under its 200. The VIX pulling back to support, although higher than it's been in the past. And you could see the dollar, despite tightening, the dollar has come down over the last couple of days. If I look at weekly charts, I think it gives you a little bit different picture. You can see the huge uptrend that we'd been in until 2015, then sideways movement. And you could see we're right at that 50 weekly moving average here, below it or at it at the minis. The NQs right above it, the YMs right below it, and you could see that last week or a couple weeks ago, the TFs, the Russell futures, failed at that. So, we're at critical levels for most of these markets. And again, the dollar come down some the last couple of weeks, despite the rate increase, and the VIX higher than it was back in the summertime, but still on its way heading down, although we'll be watching that closely. In Genesis, I have similar pictures here, the E-minis, the NQs, the TFs, the NYSE, and the YMs. And I guess the point here is that all the markets went into a daily sell signal this week, or daily buy signal. They're still pretty much in weekly sell signals, so is this a retracement in a market that's continuing to roll over and new opportunities to short coming, or is this going to be a change? I think time will tell. Now, a couple things I like to look at. These are Warden charts. This is the 10-year Treasury yield. White is the actual yield. And then you've got the moving averages of the 17, 50, and 200-day moving average. This was a line that I've been watching. This is a little bit less than 2.5. And the interesting thing is, despite rates rising, or the Fed raising rates, rates are not breaking out to new highs by any means. In fact, they're still lingering here. That probably explains why I saw strength in a lot of the things that like low rates, the REITs, the MLPs, utilities and dividend payers, home builders. I think they have some counter currents. What was interesting was regional banks also looked better this week. If you look at the AD lines on the weekly and the daily, if these were stocks, be concerned that it's pulling back here on the weekly, failing on the daily. That might be concerning and might show some underlying concern of the market. If I look at the number of stocks, participation stocks above the 200-day moving average, still relatively down compared to lows earlier this year. This is August and September lows. If I look at stocks trading above the 40-day, however, these have increased quite a bit. No surprise that it's easier to get above the 40-day than the 200-day moving average. Canaries in the coal mine, some of the leaders of the market over the last couple of years. Is this them rolling over or a great buy point? And we probably should look at these today as individuals. I think some of them probably are good buy points while others are struggling. And I think the reason why I follow the canaries is looking for signals of the market either to get out or get back in, as this has been a leader of the overall market condition. Now, this is probably the most ominous thing that I've been looking at. And my daughter's boyfriend recently went to work for Lowry, and we've been talking about this. Is Lowry's really staked a lot of their fortunes on this buying and selling pressure, and that when the selling pressure is above the buying pressure, then you don't want to be going all in on the long side. And the market's been chopping for months, and you could see that there was a cross, or almost a cross, back in July, but you did cross in August, and this preceded, by the way, the market sell-off in August. It looked like at the end of October that perhaps we were going to cross back and give a more bullish cross, but as you can see, the selling pressure still is above the buying pressure. That really reinforces to me that this is still a time for caution and not to be all in and going crazy. Now, the counter argument is this, and the white line represents the 4-week high, new low. Again, another Warden chart. Now, the interesting thing is you might say that this has reached a worrisome point and that it reverses from here. But the interesting thing is, take a look back here, for example. This may be a leading indicator where as this 4-week new high, new low went to new highs, the market followed it. So despite the fact that it started getting choppy. So it'd be interesting to see if the market in yellow, the S&P, actually follows the 4-week new high, new low line. Market thoughts. Short term, this was a low volume holiday week. You got to be careful with anything you conclude. Laggards were leading as the tax loss season abates. What was working, I'd mentioned the dividend payers, the regional banks junk off the bottom, some strength in airlines. Longer term still looks a lot like 2011. Are we in a topping period, or is this correction about over? I think time will tell. Topping, as John likes to say, is not a single event. It's a process. We still have the questions of worldwide versus U.S. economy, worldwide loosening, U.S. tightening. Keep risk management prudent, and will be interesting to see as we move out of year 7 of a presidential cycle, which is really typically a strong year, into a much more concerning year, the year number 8. Remember, stock patterns are cyclical. Where do I think we are? Gosh, I've joked that we've stayed this entire, after the first couple of months, sort of truncated the top of this, and we go bouncing back and forth between selling and buying. And, we're still in. I think the word for that's called chop. I don't think anything has necessarily changed. And we're kind of in the middle, perhaps, of that range. Therefore, I'm sort of thinking about, again, maintaining smaller positions, less positions, selling some premium, and raising cash so that when the market declares itself one way or the other, I'm ready to roll. Know your news and earnings dates. There's actually a fair amount of news. Homes, claims, continuing claims, PMI, natural gas, and crude inventories. So there will be some market movers. And the earnings, you can see very little earnings. 3 earnings only showed up at Levitt Brothers. So we've done my intro comments. Let's go look at the market, do our top-down approach, a little bit of bottoms-up commentary, and then we'll finish with my chart of the week. And we'll come back to this slide and the chart of the week in a little bit. Now, for a brief review of the market, I keep a running tabulation of spreadsheets. So let me just take a look and show you some of the thoughts that I had. And some that I thought was kind of interesting. First of all, I hope you made money last week. It was a pretty strong week in the market. So I looked at if I bought these deals at the closing price on Friday the 18th and sold them at the end of the day on Thursday the 24th. No filter was applied, and black is good, red is bad, and you could see that there were only a couple of, I don't know what was there, only a couple of these were red. So for the most part, the market was bullish. Kind of interesting to me that 2 of the bad, VectorVest top 100 stocks, which are supposed to be great stocks and balanced, were actually flat on the week. Stocks that I refer to as broken out and running, stocks that have recently broken out and usually lead the market higher, actually were down 2%, although there were only a couple of those that were on my buy list that were in that status. The IBD 50 was up 1.18. HGS 100, which is a broader group of stocks, typically was up 2.11. And the S&P 500 was up 2.76. So growth underperformed the big index. I look at some of the things that matter to me. This is not fair, so I'm going to remove that. And I could show you that my holdings, for example, the vast majority were up a little bit less than 2%, so trailing the performance of the S&P. And the stocks that I thought looked like great buys last week were up about 1%, again, trailing the S&P. What was leading? I thought this was interesting. Things that broke out the prior Friday, things that were coiling. High beta stocks had a great week, up 5%. Green candle lows, reversals were up. Breakouts were up. And then even some of the sell signal stocks were up. So to me, this was a lot of stocks off the junk off the bottom that were moving. Here is a EdgeRater report that is very important to me because it gives me a sense of what's driving the market. So one of the things I talk about is ERG, which is earnings plus relative strength plus group rank. We learned that from Ian. And typically what we see, and I always ignore the bullet point here and the bullet point there because as you can see in the gray, which is the number of stocks, there are very few stocks at the extremes. Typically, on a good year, you see a lower left to upper right movement of this curve. And you could see the gain here across this market from 12.21 to 12.24, so this was just 1 week's work, was up about 0.5%, and this is looking at all securities. And you could see that some of the lower ERG stocks actually outperformed the higher ERG stocks. That was interesting. And you look over the past week, stocks with the lowest earnings per share rank, the lowest relative strength rank, and the lowest group rank were the best performers. And in fact, those stocks that have went into the week distributing D&E actually outperformed the better actors. So that was sort of an unusual week. If I look at the entire year, you can see your lower left to upper right, the normal curve that one would expect to have. This is from January 1st to date. You'll notice that the returns have been, for the most part, negative less than 1% though. So it's very close to break even. When I come down here, we can see that this is loss, this is less loss, that the higher earnings per share rank, the better you performed on the year, the higher relative strength, the better you performed on the year, and the higher group rank. This is what you expect to see. And you could also see that stocks that were distributing as we went into the year outperformed or underperformed compared to stocks that were accumulating. Boxes are confusing. Box 7 is usually my favorite box, but it had a bad year. Now, everything here is very flat when you look at these percentages. What else do I want to show you? So the year has been kind of what you expect to see, but it's not been a year of positive returns. It's been a year of negative returns. And you could see that last week was a total reversal. From a Hindenburg perspective, no evidence. We have both new highs and new lows are below 2%, so nothing to suggest that. Bucketology, sort of a shootout the OK corral. Half the stocks, S&P 1500, are above their midline in their Bollinger Bands, half are below. There are very few stocks above or below the upper band. We look at the Woody indicator for the markets, and you could see it's been choppy really since, gosh, we came out of a buy signal in November 10th after a nice run from October 5th to the beginning in November. And we've been in chop since. Nothing tells me any different. If I look at seasonality, not as good as I thought it would be, to be honest with you. If I look at the various indexes over the next month, let's look at this group here. The VIX over the last month, 12 out of 20 years up, average of 7% higher. Semis do well. What does poorly? I guess the Dow, but for the most part, not big moves over the next 4 weeks. That I felt was surprising. And then when I looked at sectors, what's the leading sector? It looks to me like the leading sector over the next month is healthcare. And with financials typically leading to the downside. Now you notice that nobody here is a 13-1 where every year it's up. So leave that alone. From a stock perspective, let's move over here. There are some winners over the next 4 weeks, and this would be performance over the next month. And you could see certain stocks like Pharma has been up 8 out of 10 years, average 18%. Here's one, Global Partners, GLP. I don't know if that's an MLP or not. MLPs actually look like they're bouncing off the bottom, up 10 out of 10 years, average at 10%. So there might be some seasonally strong stocks. And interestingly, looking at stocks that have not had, of the last 20 years, have no more than 3 up years and at least 8 down years, there's just very few that actually made the list. All right, close this down. All right, so then I like to jump into my trade station before it kicks out of me and dies and just take a quick look at the major indexes. Now, I'm looking at a couple of things here. I'm going to look at, and that's not a major index, unfortunately, it's a very strong stock, Abercrombie & Fitch, a retail stock. I'm going to look at the color of the paint bar. This is an Alexander Elder indicator, and he kind of calls it his, sort of like a filter. When it's green, he can buy or he can hold. When it's red, the paint bar, he can sell or he can hold, but he can't buy. And when it's blue, tells him he can do whatever he wants. I look at the green arrows here, which are person buy and sell signals. These red dots, which are at the top of the price bar, or they could be green dots at the bottom of the price bar, actually represent a scanner to look for MACD divergence. The high jumps on the indexes, not really paying attention to that because none of them are extended. So I look at this across daily, weekly, and monthly. So let's start with the NASDAQ. We can hope. Well, not going to cooperate. Let's see. Well, this is not a good sign. Did it already crap out on me? I don't know why. Usually it's pretty good. Let me make sure I've got the right color here. Got blue. Well, I apologize for that. It looks like that's not going to cooperate. Let me just shut this window down and open it one more time and see if that'll help. And if not, we'll move on. Let me open up an old version of it. Nope, don't want to do that. Nope, nope. That's not going to help me. Go back and reopen the newest version. TradeStation is not without its challenges. Yeah, it's not happy with me for something. You just see something. All right. I'm not going to go there. Not sure what's bothering my TradeStation, but obviously it's not happy. So I'm going to shut it down and move on to HGSI. We already know from, actually I'm going to stop this and then I'm going to see if I can get that to work. All right, I've got it back up. Let's give it another try. So NASDAQ, you could see we're in a daily buy. We're in a weekly sell. We saw that on Genesis. We're still in a monthly buy. We got green price bars. So frankly, the buy window for me is open. I could still be looking to be going long NASDAQ-related stocks. The Dow, green on a buy, blue here on a weekly sell, still on a monthly buy. So long term, we're in an uptrend. Medium term, we're pulling back. And short term, we got a new buy signal. S&P 500, same thing, except we actually got a green bar on the weekly. So this could be viewed as bullish. You can notice the monthly is still in a downtrend, looking for a person monthly buy to come in soon. If I look at the Russells, we'll use the IWM for the Russells. You could see that despite the fact that they are the weakest, they are in a green signal, though they did have a doji on Friday on a person buy. They got blue and red on the weekly and monthly. That's kind of weaker than the others, and they're on sell signals. So I look at this, and I see that the NASDAQ and the S&Ps look okay. The Russells, just as we saw, and some of the other things look a little bit bothersome. These are some of those MACD divergence dots that I look for the bullish side and then the bearish side. And you see that they may hit for a number of weeks before they kick in, but they are good signs that something is likely to change. Very quickly, let's look at basic materials. In a buy signal, short term, weekly, and a sell. Energy, interestingly, you had the positive divergence or convergence, and it bounced this week. In a person buy, you've got the divergence on the weekly, so there might be some bouncing off the bottom there. Financials, really still on weekly and monthly sells, and on a daily sell by person despite the higher interest rates, weaker there than the others. Industrials, got a monthly and a daily buy signal, green here, blue on the weekly, still in a weekly sell. Technology, XLK, daily buy, weekly sell, monthly buy, blue here, green and green, looks like might be a place to be playing. Staples, green, green, all in, everything's a buy signal, but you've got these little red weekly divergence dots suggesting it's getting a little bit overbought. Staples, therefore, look the strongest right now. Healthcare also looks very strong. You're in a daily and weekly buy with green bars, Blue bar in the weekly, but still in a weekly sell. That's utilities, rather not healthcare. Actually looks good. I mentioned earlier that there was some strength in utilities. Healthcare looks the same in a daily and weekly buy with green bars. Actually has a green bar on the weekly, but still in a monthly, monthly sell. And discretionary, also weak, much weaker than staples. Sell signal, monthly buy, but red candle on the weekly, blue on the daily. So as I think about this, financials looked weak, as do discretionary. Gives me a little bit of sense of what's working, what's not working in the market. Now let's take a look at HGSI and how I gauge the market. So I'm going to go into user groups, Woodward and Brown. I'm going to go to Major Markets Plus, and I'm going to rank these using the T, which is a price and volume driven, highest for 1 day, a little bit for, there it is, a week, and very little for 3 weeks, but gives you the strength. Rank it by that. You can see biotech is up at the top with gold and silver and oil. As I said, this was some junk off the bottom week. Some of the big stocks, S&P 500, NASDAQ 100, S&P 100 near the bottom. So let's take a look at some of our favorites. Open up the S&P 500. Now you'll notice that it looks a lot different here, 0.9%. I'm trying to figure out why this is such a big, because EdgeRater looked back. This is looking at 5-day performance, not 1 week performance. So it's picking up a bad day the prior week, or 2 bad days the prior week, not just the 4 days this week. All right, so let's take a look at the S&P, and let's look at that, what it looked like the prior Thursday and Friday. So let's open this up. So remember I said it was up 2.7 on the 4-day weekend, 1, 2, 3, 4. When you start to throw in the 5th bar, which would have been the prior Friday bar, which is looked at this 5-day back, you can see the weakness there. So we have almost a doji sitting on the 200-day moving average on the daily. There's not going to be any kahunas the last couple of days, so let's just switch to a simple chart. And what you could see is, as I look at this, I see indecision sitting at the major market moving averages. No Hindenburg, we know that already. Daily bond goes green, weekly is red. I think I said before, this is a market that could either break out or break down. Right now, the S&P looks like an indecision day. Take a look at the Dow. Same exact story. Curiosity. Let's just take a look about squeezing here. The Dow is in a squeeze. I think most of these are squeezing. You can see the mustard yellow pointing there, whatever that means on an index. But certainly there's compression here. Same picture as the S&P with closing right on a confluence of moving averages. Take a look at the NASDAQ. Also looks like a doji day sitting right above the moving averages. Take a look at the Russell 2000, the weak sister, struggling to get above this 200-day moving average. It did break above the 17. So I don't see anything that jumps up and says this is a great market. The same token, I don't see anything that jumps up and says this is a horrible market. So we really had a sideways market last week with some rotation perhaps into some of the weaker things. If we look at the dollar, it's right in front of me. As I said, despite the raise in rates, the dollar's had a couple of days moving down. It's on a daily chart, although it was up a little bit. Well, actually, it closed higher than it opened, thus the open bar, not the closed bar, but it still gapped down. So dollar showing weakening despite raising rates. That would be good for the market, sort of. The VIX, We mentioned earlier that the VIX has come down, not quite to the level where it's been, and you actually, as you see, it has a green candle on Friday, traded down and then pulled up. So perhaps we should be a little bit concerned that the VIX is forming a higher low than it did before, and we'll have to be watching the VIX closely. I mentioned some weak things had a nice week. Look at gold. Gold popped up. Dollar's weak. Gold is stronger. Nice move over the last 5 days. 1.6%. Silver. Similar move. These have been in the doghouse for quite some time. Is this the time that they're going to bounce and be good? Maybe, but you can look back here through 2013, and I can go to a monthly chart, probably be even more useful, and see really since peaking in 2011, the metals have just been in a bear market, and well, perhaps monthly doji, we'll see. They're still in a downtrend with a 1 week bounce. All right, let's take a look at what markets might be working from an industry group perspective. 174 industry groups. Let's look for a short-term 2-day force. And we could see that last week there were a lot of groups that were up, 94. Now this is a index of indexes, so I'm going to kill that one. So I'm going to go this group here, and I'm going to delete that. So MLPs off the bottom, exploration, base metal, semiconductors, oil, gas services, diversified banks, biotech, specialty pharma. A lot of these are bounces off the bottom. Again, I made the comment, it was interesting to see things that like low rates, like REITs, like utilities, did well for the week. And at the same time, the banks were strong as well. MLP is another thing that likes low rates. Let's just take a look at a couple of these and see if any of these look as potential buys. And on my buy list, I picked 2 of them. So we see bounces off the bottom, right below the PSAR dot. This is the Williams Company. Pays a 10% dividend. That's a big driver here. These all been, they look like gold stocks. They've all been getting hammered. Still, the weekly bongo is red. Energy Transfer, 8.5% dividend. ETP, that was ETE, 12.4% dividend. Kinder Morgan, 12.7%. Williams Partners, 11.8%. Plains Group, 9.5%. I looked at a number of these, and a couple of them made it to my buy list. And we'll look at those later. But these have been getting hammered, but have got huge dividends if they can continue to pay them. I think what happened this past week is one of these companies actually came out and said, we're still paying our dividend even though the stock is down. Has oil bottomed, or is it going back to the 20s? I think that's a debate on CNBC. These stocks voted that it's bottomed, at least for 1 day. And do you own any of these? Is it time to jump into them? These are stocks. Let's look at a weekly, and you could see the bear market that this is Continental Resources was in, topped in September of 2014, has been down all year. Go back to a daily. It's bounced. Is this the bounce that matters? Time will tell. Still a lot of red in the bongos and the longer-term force because of the degree of the downtrend. Continental, Devon is another one. Same exact chart pattern. Anadarko, some of these are very high-quality companies. Some will survive. ConocoPhillips, Pioneer, Southwest, Range Resources, Whiting. It'd be nice if I had Lou Powers on this to comment about it from his perspective. But these are things that bounced this week. And when I say junk off the bottom, these were junk off the bottom. If oil's done falling, you want to be here. If oil takes another leg down, they're going to follow. Base metals. I mean, who would think that copper and aluminum, considering the slowness in the world, would be leading the markets higher? So is this bargain hunting? Or is this going to be a generational low and a great buying opportunity? Pays 2.6% dividend. Freeport-McMoRan, not only do they have the issues of being a big copper and gold player, they're in the process of spitting out some energy that they thought would be smart to acquire over the last couple of years as well. Bongo Weekly continues to be red. Alcoa. Done this before. It's got the 200-day on sitting on top of it. You look at a weekly, you could see this stock also in November or so 2014, corresponding with the Hindenburg in the market. That's interesting. Had a big rollover, broke through its 50 back earlier in 2015, and has been in its own little bear market ever since. Now, is this the bottom in aluminum? Well, time will tell. I usually don't go below the index, but let's just take a look at Century. Well, the Cameco is one that I thought was interesting, pays a small dividend, but all these things are just in bear market land, and one of these days it's going to be good to be in them, but you wonder how much of this wasn't the people that took tax losses buying back in because they're longer-term believers. Here's Century Aluminum, another one that used to have great earnings per share growth, and then it just rolled over. Look at the demand supply. People are buying these stocks. And again, junk off the bottom. Next one down, semiconductor devices. Good companies. Let's take a look at their charts. Whoops. Obviously, they had a great week this week to be here on the list. Again, Qualcomm bouncing off the bottom is at a low. Texas Instruments, nicer looking chart going sideways. You know, this is the kind of stock that if I wanted to own Texas Instruments, it's a kind of pattern that I like because to pull back to the 50 at support, I could set a buy signal above that PSAR dot. I don't like the red bongos. Did have a kahuna. This is one that I'd probably be watching. Intel, very similar pattern. It's already broken above the PSAR dot. Has been a leader this year, interestingly. NXP is below the 200. I don't usually go below. A couple weeks ago, we talked about Avago, and it did break out. I think this is one that we talked about as a potential buy as it was bouncing around its 200-day moving average. I like to buy stocks off of major support when they get momentum. Here was a kahuna and a pocket pivot, and I think this was something that we actually talked about on this date. Not seeing a lot of things like that today. Oil and gas services, another beaten down group. We'll take a look at the first couple because they're kind of bellwethers. Halliburton, I guess it's a higher low, but it's a lower low in this one. Is this a bottom on Halliburton? I don't know. Why would I want to buy this now? I'd want to see evidence that something is different this time. I can look at Schlumberger and same answer. Is it different this time? I don't know. If oil goes up, these things will follow. So there's a lot of interesting plays here, but this is junk off the bottom. Take a look at diversified banks. Again, these should be winners if the economy goes up, and some winners if rates go up. Well, a little bit better looking than everything else we saw. Earnings per share growth is rising. Pays a dividend yield. Had some kahunas this past week coming off of a squeeze, mobile breakup from a squeeze. JP Morgan looks like it might want to go higher. Bank of America pulled back to a squeeze right above the 50-day moving average. I'd like to see a kahuna, but note the weekly bongos are negative. It pays a 1.2% dividend. Citigroup, less exciting. It's below the 200-day moving average, and Wells Fargo is going to struggle there for a while. So Bank of America and JP Morgan look a little interesting. Biotech, what really happened here was Celgene came to a patent agreement, and they are allowing an Indian generics manufacturer to start to sell a generic of their blockbuster Revlimid earlier than they felt was appropriate. And in exchange for that, they have got a bunch of what's the word I'm thinking of? They have a bunch of concessions, and that the ones that are got that they settled with until 2022, which is 5 years from now, 7 years from now, there will be no generic, and then they can only sell limited amount until 2026. So if you own Celgene, this just means your big money-making entity just got their patent life not necessarily extended, but it's being acknowledged that they have additional patent life, which is great if you're long the stock. You can notice everything is green here. Mobile breakout, squeeze, Bible gap up on Friday. It closed near the high, held it on Wednesday, held it on Thursday. I think Celgene goes higher from here, though many of you know that I've had a big position in Celgene over the years. I actually sold out this year because I thought it was topping. At this point, I'm interested in getting back into Celgene. Now, I did change some of how I do things this year. I actually took a ton of profits. I took 7 figures in profits this year. So of course, I had in the later part of the year, I had some losses to write against it. But on some of my long-term positions, I don't know if there's any reason not to take profits in something that's gone long-term, because the interest rates aren't going to get any lower. They could go higher with regime change. Frankly, they could go lower if somebody gets in and takes away capital gains taxes, in which case everything I own will go crazy. So I'm starting to take profits on my long-term. I don't mind rebuying them after pullbacks, and now I've got short-term capital gains, because if I can keep, I think taking profits makes sense, and holding long-term capital gains for years and years, I get the benefits, but this year taught me that sometimes those go away. Think of United Rentals and other stocks that had you not taken profits, you would have given up some long-term gains. So Celgene, I'm back in. I think it goes higher with that agreement. Gilead, I struggle with this one. I've been a bull on this for a long time, and then it's just gone sideways now for the better part of 14, 15 months. It's caught in a little bit of this fight over pricing. Its earnings growth is now slowing down, which I think is somewhat ominous. They've got a ton of cash. They trade at a very small multiple. They own the hepatitis C market. The issue is, what are you going to do for me next? And then I think that's what's holding the stock back. I'm probably not going to be bullish until it gets above that 200-day moving average. Amgen, sitting above the 200, it's really going sideways. I prefer Celgene. I mean, if I look at the IBB, of which Celgene has a good weighting, it's still below the 200-day moving average, but you notice it's coming out of a squeeze. Everything is turning green. I think biotech may turn out to be interesting. Just right now, it's hard to find one that I want to jump in and be all over. Celldex is one that I've also taken a position in. They've got a vaccine for brain cancer. The bar to approval there has got to be incredibly slow. Some of their data looks good. And it's had a nice move off, but it's sitting here, broke above PSAR breakout. Everything's green here. Above its 50, above the 17. I think Celldex looks interesting. And then sort of this is the one, there's between SRPT and BMRN. One of these is likely to get an approval in muscular dystrophy. Think unlimited pricing potential in a decent-sized market. So I think both of these will be movers in the new year, and they may move together. Specialty pharma, Adams was up big on some data this week. It's probably too far gone for me to get into it. Relipsa, no earnings per share growth, big volume stock, lots of demand, 7.5%. I don't know anything about this stock. I'm going to probably research it later. Everything is green here. Mobile breakout, pocket pivot. Break above the PSAR dot might be interesting. I don't like the earnings per share. I do see that it had some revenue. Maybe it's about to change. Valiant, are its troubles over? Broke above the 50. I'm back long Valiant. I think Valiant assets are worth much more. They got rid of their specialty pharmacy. This resulted in a pullback of expectations for the next quarter. Still a very profitable company. Its multiple has come down to what you'd expect it to be if it was a slow-growing company. Lots of demand for the stock. I think Valiant goes higher. Horizon is another one that got pulled down, and I've been bullish about Horizon for a long time. Love the earnings per share coming into the stock. I've actually took advantage of, as I told some of you, a sell-off that had in October and bought some leaps that were really cheap that are now in the money, so I'm a happy camper. We'll be going back to this group with my stock pick of the week, which we haven't talked about yet. Integrated oils, again, energy showing some strength. Is it time to buy ExxonMobil? Well, these guys are probably more likely to survive than the small E&P players. There may be some consolidation. The weekly bond goes still red candle high here, pays a 3.7% dividend. Just really isn't going anywhere right now. BP, similar story, pays a 7.4% dividend. Chevron failed at the 200, pays a 4.6. Junk off the bottom rallies, took these guys up as well. And talking about junk off the bottom, precious metals, Barrick Gold, Newmont Mining, Gold Corp, all these in their own little bear markets. ABX actually going pretty sideways over the last 3 or 4 months, broke above its PSAR dot. Maybe it can run up to the 200-day. Everything is green coming out of a squeeze. Newmont, similar picture. Broke above the 50. Looks pretty good up here, except the 13-day force is still red. Gold Corp, again, mostly green. Mobile breakup from a squeeze. Been distributing. That's why that pinkness there. Randgold. So these are stocks that have been beaten up. So hard for me to get excited by last week. A lot of junk off the bottom. But you can't argue that, for the 4 days, the market did well. Now, I'm a believer that the Santa Claus rally is only between Christmas Day and New Year's. So maybe we're going to get a nice little run this week. Let's go talk about my chart of the week. So I started a group called the Pug Users Group. Just a quick promotional thing here. Doesn't cost any money. Either you have to have been to one of my live meetings, and except for when John does his teaching, I invite anybody that's paid to come to one of my live meetings to come and sit in the meeting. But really, the real members are the ones that own HGSI and are lifetime owners of John's Indicators. To me, it's a great combination of tools that helps in my tradings. I try to teach people. John helps us to learn how we can become better traders using these tools. If you're interested, contact me, hgsidoc@gmail.com. Sometimes I can get some special deals on the indicator package for those that are HGSI users. And if you're not, I could probably get you a special deal on the combination if you're new. Charts of the week. These are for educational purposes only. Trading, especially options, carry substantial risk of loss. I do not warrant any expectation of return. I may or may not already have a position. I usually take the trades that they execute so I can discuss. And I'm doing this not to provide stock tips, but to openly discuss how I take the trade, why I chose a specific stock or option strategy, and where I would plan on taking profits or placing stops. I love the pattern that I'm going to show you. I'm not sure I love the company. There are things that I like a lot. It's a little bit low volume. It does not have options. I picked for this week CXRX. This is a specialty, well, I guess they call it a biotech. I think that's a misnomer because when I went and looked at it and what it does and went to its website of Concordia Healthcare, seems more like a specialty pharmaceutical company to me. Now, I just said something that, let me just show you because I think it's really valuable. Giving out one of my trade secrets here. You can go to the websites of almost any company you're looking at buying. And when you go to that website, you can learn all about them. If you click on investors and go down to presentations, you can actually get a copy of their analyst presentations. And you can get an idea of what they do, what their expectations are, sometimes what their risks are. They have a lot of old drugs. They have some orphan drugs, and they have some specialty healthcare distribution on their orphan drugs. It's an IPO. That's why there's nothing to the left of the chart. Why did I like this? Well, you can't really see it here, but it's got huge amount of revenue, earnings and revenue growth. I mean, it doesn't have a huge amount of revenue, but it made $1 the June quarter, $1.31 the September quarter. It's supposed to make $1.49 this quarter. So it's growing at a big number considering that it didn't make money before. It trades at a multiple of 18, which is much less than its growth rate. It pays a small dividend at 0.7%. Its average volume is 400,000, so that should raise a flag for some of you. The chart pattern, after its IPO, with the Valiant issues that fell off a cliff, bottomed in October, is now breaking out to I won't say post-IPOs, but certainly post-September collapse highs. You'll notice everything up here is green. It's coming out of a mobile breakout with the squeeze. It had 2 kahunas in a row. It had a pocket pivot earlier in the week, and the relative strength of this stock versus the S&P is increasing. A lot of the things that I like to see. You notice I put blue in there. It's supposed to be the color of the sky, that there's nothing above it. No lines, no moving averages. And frankly, if I was a short-term player, I would have been out of the stock back here. So, and most of the people who are in the stock probably have been buying it during this dip, and you're breaking out or getting close to the dip highs. So you have blue sky above it. Although I guess you could argue that this isn't far enough away to say there's no overhead supply. But it's had a chance for the moving averages to catch up to the stock, and the stock is above its moving averages. If I look at with a person indicator set, in orange it tells me it had a high close doji on Friday or Thursday. That's probably the most bullish of John's indicators. On balance volume on the weekly and the daily are breaking out, new high on the daily. You have a person buy signal on the weekly and a buy signal on the daily. I'm maybe 2 weeks late on this, but the stock hasn't done much. It's gone mostly sideways. It's had recent coming out of a squeeze on the daily, pocket pivot on 2 days ago, PSAR reversal within the last 10 days, and Force and Kahuna both fired over the last 2 trading days. If the market's stable, I'm thinking of buying the stock if it takes out the prior high at 41.45. My target is 45.80 for target 1. My stop is 37.10. To be honest, at 10% risk, this is a little bit riskier than I want. But when I looked at the chart, I decided I would allow it to go back to the bottom of these dojis in the 17-day moving average. In that area, anything below that, my thesis for buying it has failed, and I want to be out. It's still a few percent higher than I would like it to take. Over the last 6 months, I've been really good at picking stocks. What happens is they move to my target very quickly, and then they die. So what do? I buy it, and I take half off at target 1. I then immediately raise my stop to break even or a small profit, and I let the trade run. By doing that, I put money in the bank. I pay myself for trading by taking profits and by raising the stop. Except for a gap against me, I should lock in the profits I've made and maybe pick up some more if I trail that stop up. So, go back into my HGSI and show you some of the stocks that intrigued me for this week. Mind you, all of my analysis is subjected to the fact that we're dealing with the junk off the bottom week, and it's going to be an interesting week to see what happens. So let's take a look at some of these real quickly. Let's go to a scorecard. All right. We'll look at the top 5 or 10, and then I want to look at something with seasonality. JKS is a solar stock. It makes money, got some earnings per share growth, good demand this week, breaking out. Solar stocks in general had a big week. You could look at CSIQ, you could look at SUNE, which has, I think, some debt issues. You could look at many of them, or you might just want to buy TAN, which is the ETF, which doesn't look so hot here, but you might say this is a flag forming here. And if it can break out above that flag, TAN can go run all the way up to the 200-day moving average or beyond. Personally, I prefer JKS, and I'm along that. Neophotonics, semiconductor stock, not a big stock. It trades at about $10 a share, give or take. You can see it's been bouncing around on the weekly. I guess kind of a cup and a handle and potentially breaking out on the weekly. On the daily, broke above the PSAR dot. Everything's green, had a kahuna on Friday. I like this pattern, don't like its earnings per share growth. This is on my buy watch list, and I'll be looking at it more. Abiomed, this is a healthcare device. Not much earnings per share growth right now. It's been a takeover discussion. It's pulled back to the 200 and the 50, coming out of a squeeze. Looks like it wants to go higher. Boyd Gaming. Some of the gaming stocks have had a run as there's been some talk about improvement in Macau. Well, what about a non-Macau's company? What about a U.S. gaming stock? Boyd Gaming, uptrend from 13 up to 21, pulled back, sitting right on the 50 here. Weekly bongo still red, everything else is green. This looked interesting to me as well. Trina Solar is another nice looking solar, broke above its resistance, everything here is green. Here's one of the, take your poison on your choice of midstreams. I chose Earthlink and what's the other one I looked at? And Summit. So look, ELNC and SMLP. Let's risk pissing off the trade station gods. And I'm almost done. I'm getting tired, and you're probably getting tired of hearing me. You got plenty to do today. I've lost my data source, so forget it. It's not going to happen anyways. Here's SMLP. It's broke above the 50. Had a kahuna last week. Pays a 12.5% dividend. I'm tempted to play here with a stock just because of that dividend. Another one that I thought was kind of an interesting dividend was Starwood Property Trust. There was a legislation, U.S. legislation, where they added verbiage where there was a risk that some of these gaming and hotel leisure REITs might lose their REIT status. That would be problematic because it's a tax benefit. And dividend yield here is 9%. On a chart that looks like it's pulled back, reverse, and moving higher. Everything's green there. That's Starwood Property Trust. A lot of interesting dividend plays. Let's look at the canaries, because I know a number of you probably hold them, look at them, and frankly, I need to look at them anyways. Alphabet, uptrend, sideways, sitting right below the PSAR dot. Its relative strength versus the S&P turned negative. I don't like all the red there. What would it take for me to buy Google? It would take a kahuna to come in and a big move above that PSAR dot. So I'm going to call this, it's parking. Maybe it'll come down to the 50 and give me a touch and go. So I'm not buying. Amazon.com. Love this stock. I've been long it since about 450. Earnings per share starting to pick up. Not sure I'm happy about them buying planes to become a logistics provider, but same story as Google. Looks tired right now. Everything's red here. I'd like to see a kahuna and a breakout before I start buying it. Maybe it will come to its 50. Apple. Broken down, not interested. Below the 8-day, earnings per share slowing down. Has Apple topped? And is this it for Apple? I don't know. But right now it failed here. Looks like, is the low 90s a risk for Apple? Could be. Not to say it doesn't ultimately go higher. Not buying. Facebook. I find Facebook to be interesting. It's drifting lower, bouncing off the 50-day moving average. Had a small update on Friday. This is one that's on my watch list. I already have a pretty substantial position I want to keep adding. If I can, it's got earnings per share growth. Does not pay a dividend, but not yet. It's squeezing. Let me see some momentum move, a pocket pivot, a Bible gap up, a kahuna. Show me some momentum. LinkedIn. It's dropped below the 50, turning red, same as the others. Not now. Now the one that's the most interesting, Netflix. This is where I'd like to be seeing some of the others to drop to for me to get interested. Netflix has some great seasonality coming into the stock, which we're going to look at. It's pulled back to the 50. I'm sharpening my pencil on Netflix for a number of reasons. I also have a current position. Earnings are out January 19th. That's the key. Price line, nope, below the 50. And Tesla below the 200. So right now, these look very tired at best. Netflix looks the most interesting. Let's look at some seasonality on Netflix and then say goodbye. So here's Netflix. Here's a chart in Seasonality Trader. What I've done here is I've asked it to graph Netflix and to scan for strong and weak times of the year. Green is strong. The yellow represents 10 years of data, the green 5 years of data, and it predicts an average movement based upon past performance. So what do I learn from this? I learned that we're going into a very strong time of year. If I buy on January 18th and sell on February 26th, 10 out of 10 years positive for a 30% average return. If I buy on March 14th and sell on April 25th, 8 out of 10 for 16% return. Every year I talk about this, I say the same thing. You have a high likelihood of Netflix going higher starting in the middle of January. One of these years, it's going to go against me. So this could be the year. There's no guarantee. That said, if I told you a 10 out of 10 chance of winning the lottery, you'd probably be going to buy it. So let's go look very quickly at Magenta Trader. And they change a lot, so for the better, I have to say that he keeps improving it. It's just not yet, to me, where Seasonality Trader is. And I hope this doesn't mean that I'm kicked out of the program. Because I'm going to take one quick break. I'll be right back. Okay, I'm back, and this is Magenta Trader. Similar chart in that it's got it's called a variable scanner, so it's not fixed number of dates. And it's telling me that if I buy it here, which would be January 14th, and I hold it for 32 days, it's been up 10 out of 10 years, 28.9% return. If I buy it today, if I buy it on Monday, and you look at 30-day return, you could see it's up 7 out of 10 years, an average of 41%. If you look at some of those returns, some of the bigger returns have been the last couple of years. So we are going through the uber seasonality time of the year for Netflix. 1 year it's not going to work, and 1 year the stock is going to die after earnings when it misses because of the number of people that are piling on. Now, this here is sort of let's make this smaller. You can see that Netflix has been in a nice trading range. It's at the bottom of its trading range. Might be a good place to be buying rather than buying it at the top of its trading range. So I think Netflix looks interesting. How do I know about this trade? Well, I know about this trade because I take it every year for the last several years. It's been a great trade. But there's this thing called a calendar. And I can go in this calendar and say I want at least 10 years worth of data. I want to tie it towards earnings. I want 90% wins. I want at least a change of 10. I want there to be some option, so I'm going to put at least one. And I want price to be at least 5. No, for seasonality, I want it to be at least 12. And I'm going to hit enter. And I'm going to start to populate some charts. Now this looks like it's December still, because there we are. So let's move to January. Now, interestingly, they're giving me a 9 out of 10 starting on the 15th for Netflix. But starting on the 18th, you're out 10 out of 10, up 10 out of 10. So I can use the calendar to help me find these things, or I can, where is that calendar at? Hello. Or I can look at them individually. All right. So on that note, well, let's take a look at GLD. That looks kind of interesting. Is this a seasonally strong period of time or not? Let's just take a look at the gold trust. What does this tell me? First of all, it looks like a mess because gold has been chopping for some time. So gold is in a downward channel. It's the top of the channel. But from a seasonality perspective, it's been up 8 out of 10 years, averaging 6.6%. I'm still a little bit leery of gold in its current downtrend. So take a look, make sure I handled what I wanted to handle today. Talked about the market review, looked at some of the edge rater scans in HGSI and TradeStation, looked at our top-down analysis. I use a number of different scans for bottoms up. With my TradeStation not being happy with me today, I'm not going to play further there. Showed you seasonality, showed you my chart of the week. I think at this point I'm going to call it a day. Have a great trading week. Have a safe, healthy, and happy new year. Be careful out driving. We all know what happens on New Year's. Good night, everybody. And happy holidays.